Hello and welcome to the first video of the capital budgeting series. We're going to start by talking about the NPV basics, net present value basics. Just to give you the context, our valuation formula right now can be called NPV, or net present value of all future cash flows. And if you notice, cash flow zero is not absent, but at the right of the equation as a minus, because typically we can assume that projects have a negative initial cash flow. Cash flow zero will be negative over the investment into this project. But let's not get ahead of ourselves. What is capital budgeting? Is the analysis of potential important projects, long-term decisions that involve large sums of money. These are very important for the firm's future. It could be an expansion into a new market. It could be replacement of important machinery, things of that nature. What are the steps in doing this thing? First, estimate our cash flows, assess how risky those cash flows are, calculate a WACC for the particular project, and then just evaluate those cash flows using NPV. What are some of the examples of categories? Well, you see them here. You can pause this video to look at them, but it can be from safety to mergers to replacement to expansions, etc. An important distinction must be made between independent and mutually exclusive projects. We say the projects are independent when the cash flows of one are unaffected by the acceptance of the other project. We can do one or the other, one and the other. If the projects are exclusive, mutually exclusive, then we need to choose one or the other. One or the other, we cannot do both. So imagine that we have two projects. One project is going to call project front-loaded and a project back-loaded. You can see that the first project, project B, is back-loaded because the cash flows tend to happen at the end of the project. If you see, the $60 and the $80 are happening at the very end in years 2 and 3, compared to the front-loaded project that most of the flows are happening at the beginning in years 1 and 2. Interestingly, if you look at these two projects and you calculate only the net value, not taking time of value into consideration, you will see that 100 minus 150 here would be a $50 gain, compared to this one that is 100 minus 140, which would give us only $40 of gain. So without taking time value money into consideration, project B seems to be better. What is the project NPV? Let's start with the backloaded project. We just need to bring these cash flows to present value using the discount rate or WACC of 10%. We can do it one by one, like the example here, 100 plus minus 100 plus 909 plus 49 plus 60 equals 18, compared to the project that is front-loaded that gives us 19.98. In essence, project F is the project that we want to keep because it's a project that makes us richer. Let's take a look at how we do this in Excel. So in this Excel sheet, I have copied the cash flows for our two projects, backloaded and front-loaded, and we're going to calculate the NPV using Excel. We need to use the function NPV. We'll ask us for a rate, which is the WACC that was given. We put a comma, and we put the cash flows. Here we need to be careful. We only need to put those cash flows that need to be brought to times 0, which are 1, 2, and 3. We're going to close parentheses, and we need to add the investment of the cash flow 0. This will give us 18.78. I'm just going to copy this formula right here, down here. 18.78 compared to 1998, and these numbers should be the same as the numbers that we had in the other presentation. And you want always to get richer. So we want to get the project that makes us the most money if we have to choose between two mutually exclusive projects. So which one is the one that adds most value? In our case, project front-loaded has a higher NPV than project back-loaded, so this is the one that we will like. Note also that NPV depends on the cost of capital. So question here, which one would be the best project if the WACC was only 8%? Let's take a look at it. Earlier in this video, we said that if the interest rate was 0, the NPV of this project backloaded was going to be 50, meaning all these cash flows were going to be equally weighted. There was no less risk or no more cost for waiting 3 years for this $80 to come to 0. But as interest rate would go higher, this number would change. So if interest rate was 5%, still the fact that this project backloaded has higher cash flows makes it more attractive. But it gets to a point in which even a 9% project front-loaded is more desirable than project backloaded. For example, at 15% is almost double the net present value. Why? Because we get this cash flows right away, and this the discount on this $80 at 15% is so significant that it brings the NPV value down. In our next video, we're going to talk about the internal rate of return and NPV profiles.